Kia ora, morena, everybody, and welcome to the launch of our latest research report, Voices of Aotearoa, Demand for Ethical Investment in New Zealand, proudly published by RIA and Mindful Money. Tēnā koutou, tēnā koutou, tēnā koutou katoa, ko Dean Higiti taku ingoa, no whakatua hau, he papa hau, ko te whānau taku tuatahi. Ki tau ira ahoa I te ao Māori, engari mamihi ka tika, ki ngā tangata whenua o tēnei rohi. I ngā kia ngui anō, ki tēnei mahi, ki tēnei kaupapa, tēnā tātou katoa. I'm Dean Hegarty, co-CEO at RIA. Gives me great pleasure to host you this morning for the launch of our latest report. We've got a very full hour of content for you this morning. We're going to start by taking you through the key findings of the report before the kōrero, with the panel expanding on those key takeaways and answering your questions. The Q&A function on Zoom is live now, so please submit any questions you have as we go. I'll do my very best to make sure that we get through all of them. Very quickly, just on RIA, I think most of you know us. We are the industry association championing responsible and ethical investment in Aotearoa and Australia. Our members make up 75% of the professionally managed funds in the region, including the overwhelming majority of KiwiSaver providers, fund managers, financial advice firms, and community trusts within New Zealand. We are also very fortunate to partner again this year on this report with Mindful Money. Mindful Money, who again, most of you will know, are a consumer-facing charity that aims to make money a force for good by empowering consumers, engaging investment providers, and advocating for change. And finally, to our industry partner, Australian Ethical, who are a long-time supporter of this research on both sides of the Tasman and have a very long history of delivering in the ethical investment space. And so to the report this morning. This is the 7th year we've published the annual report based on what is Aotearoa's most comprehensive survey on consumer attitudes towards responsible investment. And the big reason why research like this is so important is that we are operating in an industry and in a market that is just evolving at such rapid speed. And a lot of that change is being driven by changes in legislation, a lot of market conditions, but investor expectations are actually evolving just as rapidly. We're seeing cost of living pressures on top of broader economic challenges that are having a real impact on the needs of the communities that we live in and on our financial priorities. Here in New Zealand, we're seeing the ever-rising damage and costs of things like climate events, while further afield, what is an increasingly complex geopolitical landscape is at the front of our minds, and in some cases, really challenging what were previously accepted norms. And if you need to be making sense of all of that complexity, hard data is absolutely critical. So for this report, we've surveyed 1,000 Kiwis, responses from a group that is geographically and demographically reflective of Aotearoa. We do cite throughout the findings quite a bit of generational demographics, so would encourage you to just take a look at the age groups there to the right-hand side, worth making note of those. And finally, just to note, this data was collected at the beginning of 2024. So to begin running through the key findings, I'd now like to welcome Barry Coates. Barry's the co-CEO and founder of Mindful Money. I'm sure many of you know him, a long-time friend of RIA and a huge advocate of both this research and the broader ethical investment industry. Kia ora, Barry.
Kia ora, Dean. Thanks very much. So let me just bring up this presentation. Great to be here, and we're counting off a long list of these annual events. So I think we're on to our 7th, and it provides really good trend data on the survey. Thanks to RIA, our partner in this research, and of course to Australian Ethical for generous sponsorship of it. So I'm going to run through the start of the presentation, and Dean's going to carry on and pick up the story. I'm going to start first with the fact there's sort of broad knowledge and awareness. We saw a big increase this year in knowledge and understanding amongst Gen Z. So it's a really kind of interesting insight into the demographics. we've really seen young people come into the picture on ethical investing in New Zealand in a way that wasn't the case previously. So Gen Z, 18 to 28 years old, we've seen a big rise in them understanding what ethical investing is. And I think that's a really important finding. And I think it's um, in a way a product of a lot of hard work in trying to raise awareness amongst young people. There are still a lot of people who kind of know what ethical investing is, but are a little bit confused about what it really means. So I think we have got further work because people often are uncertain about what you mean between ethical investing or sustainable investing or ESG, etc. And I think that shows an ongoing challenge for us. A headline for these reports is a number of Kiwis who expect their investments to be ethical or responsible. So there's been an increase of 3% in that to 77%. But the two big changes are a significant increase in the percent of women by 5% to 83%. And now there is a significant gap between men and women, and that's been rising across a number of these categories. But again, Gen Zero, an increase of 12% to 87% expectation that their investments will be ethical or responsible. And I think that really is an interesting finding. Elsewhere in the survey, we also talk about what people's expectations are in terms of financial returns, and almost half of people expect that ethical investing will perform better over the long term. 40, just over 40% aren't quite sure, but only 10% disagree. So that's a kind of in a way, a repudiation of the myth that people think there's a trade-off here between investing ethically and good returns. Certainly the public think that those two things often go together. Along with the expectation to invest ethically, a number of people would shift their funds if they found out that their current provider wasn't behaving in a way that's consistent with their values. And again, that's skewed on the grounds of age. It's possible that people who are baby boomers have a great deal of loyalty to their current provider. They may be insecure about shifting their funds at a later age, but certainly that propensity to move is far higher amongst Gen Z and millennials. So it does send a message to say that people are interested in finding out more about other alternatives if they find things in their funds that they don't think should be there. And what are those things? Well, there's a long list down the right-hand side of the questions that we ask. They fall into basically 6 categories. So human rights is the highest, around 92% for human rights, supported by labour rights abuses and Indigenous people's rights. Second issue is environmental damage is also high. Animal cruelty is the next category, and weapons at 80%, fossil fuels below that, and social harm ranging from 75% for gambling down to 58% for alcohol. So there's a couple of points about that. I mean, one thing is that these percentages have been really stable over the past 7 years. So in our work with RIA, we swapped over data providers to do the research, and actually these numbers didn't shift. And so they also haven't shifted much over time. And the rankings of those factors is very consistent over the 7 years. So it gives us a lot of confidence that the surveys are giving us a real picture, and that also reflects our understanding of what people are saying. The other thing is that there's much more strongly held values than in Australia. That if we look at the comparatives, for example, the human rights, 92% of people in New Zealand want to avoid human rights abuses. The figure in Australia is 76%. This is a big change across the Tasman, and it is something of a unique characteristic amongst New Zealand investors. Again, this is stronger with women, although some of the categories vary between women and young people. Particularly, we're always a little surprised that fossil fuels isn't higher, and it turns out that fossil fuels are particularly older men not particularly keen. So, to summarize, New Zealanders do prioritize companies with ethical practices that align with their values and belief, key practices of human rights and animal welfare, preferences for avoiding issues are stronger than Australia, and the focus is on positive ethical practices rather than just avoiding things like tobacco. So that's to say that it's the way companies behave that people are looking at. So it's human rights violations. It's the way they behave towards animals. It's their kind of stance on these issues that is a company by company basis rather than in the old days there was an assumption that if you excluded tobacco from a portfolio, then actually that reflects most investors' concerns. And I think that's really no longer the case. And we're seeing that there has to be a far more forensic look at the companies and how they're behaving and how they're incurring controversy and poor practices that are really important rather than just sectoral exclusions. Another finding from these surveys, kind of interesting, is that New Zealanders would save more if the funds were invested in good. So there's a link between ethical investment and savings. So 56% of people would be motivated to save more if they knew their savings made a positive difference. So this is kind of both an encouragement to fund providers to talk about the good things that are happening within their portfolios, but it's also an issue for policymakers to say if we really want to engage younger people, why aren't we engaging them on the fact that their investments can contribute to climate action, or their investments can contribute to ending of human rights abuses. So it's an interesting finding, and I think one that stood the test of time, and we get these repeated results. Again, uh, um, the preferences are stronger amongst Gen Z and Millennials. Another finding that's happened over time is that there has been a stronger desire for investing with positive impact. So the survey says 74% of Kiwis would be prepared to invest in a dedicated fund that aims to create positive impact. And of that 74%, actually 20% would invest even if the returns are likely to be lower than benchmark returns. 54% would expect returns that are similar to conventional funds. So that's an interesting finding that most people would be willing to invest in a positive impact fund, and there is a smaller proportion who would be prepared to accept a lower return. But the other factor in here is when we ask the question of it's important to me that my investments deliver a positive impact in the world. 66% of Kiwis, so 2/3, say it's important that their KiwiSaver investment fund delivers positive impacts. So this is much more around mainstreaming investment. This is the expectation on all funds, and as we see that people not only think it's important that this delivery happens, but also that the investment provider informs the investors. So I think this is something that we are going to see more of in future. And it's, I think, good news for New Zealand, where the mainstreaming of impact investing has started. There are a number of funds that are now building social housing or renewable energy or startup companies with a positive purpose into their portfolios. and that's attracting a lot of investor support and public attention. So that's it for me. I'll pass back to Dean.
Wonderful. Thank you very much, Gary. Moving on through the slides, we come to greenwashing, which is just such an important piece to the puzzle for us because it really does speak to client trust and the trust that they have in those investment providers. So what we're seeing for the first time now, more than half of respondents are saying they're concerned about greenwashing. And what that means is that effectively they don't believe the promises around sustainability that are being made by funds. What we see when we break that down is that those with university degrees are more likely to be skeptical. The biggest differentiator really is millennials, who are particularly concerned about greenwashing as an issue. And it's really important to pull that out because if you think about millennials as a group, they are that group that are entering or now in their prime accumulation years when it comes to things like salary, which translates to KiwiSaver, as well as other sort of wealth markers. It's a group that is really starting to enter in and becoming a much bigger player in the broader investment market. So another real indication of the direction of travel that this is starting to move in. The second piece here is looking at quantifying, let's back a little bit, Bronnie. The second piece here is really quantifying just how important third-party verification is for investors. So 59% of respondents tell us they're more likely to invest in an independently verified product. And again, it's that key group of millennials who have lower trust in the sustainability claims. They also place more emphasis on the third-party verification. So this data we see aligns really closely to what we see at RIA as the verifier of sustainability claims. We've seen in the last couple of years in particular a huge influx from New Zealand fund managers who are wanting to have their funds certified. RIA certification now covers more than 60% of the KiwiSaver market. Would absolutely expect that as the policy settings continue to tighten both in New Zealand and abroad, that's something that we'll only see continue. Next key finding looks at barriers, and I think is a real sobering one and one that we're going to need to figure out a way to get around if we're going to find a way to get all of this demand into the ethical funds that exist and get some capital aligned where we need it to create the change that we need to see from a sustainability perspective. So still seeing lack of time and not enough independent information as the biggest barriers. So from a call to action point of view, one thing I would definitely say is, if you're a fund manager or if you're a financial advisor, and even for us as a third-party verifier, we have all of this information, right? And if anything, we're starting to get to a point where we've got more information and too much information. We have to make it easier for people to be able to access that information and to be able to understand it, because they're telling us that if we do that, that we give them all of the information that they need, the demand is there and the desire is there for them to be investing in positive impact products. So a really important key piece. Moving on to the expectations on financial advisors, and this is a group who continue to see the expectations that people place on them continuing to rise. So the two biggest growth areas in there are people expecting their advisors to be knowledgeable on responsible investment and financially lucrative investment options. So the context of the finding that Barry mentioned before, where 46% now expect that an ethical fund's going to outperform, the reality is that now the knowledge of responsible investment products and financially lucrative options is absolutely linked. And if you look at that top finding, which is that more than half of Kiwis are telling us that they have sought financial advice at some point in their lives. So that really does underpin just how important the financial advice area and space is to be able to start to direct some of this client demand. And also, as we're looking at that group who are millennials, Gen Zs, who are much more passionate about this space, they were less likely to have reported that they'd sought financial advice in the past. So again, if you're a financial advisor, this is the demand that's coming down the pipeline. How are you going to be ready for it? What preparations are you? What preparation do you have that's taking place? Last key finding to highlight is just the intention markers about ethical investments and products. So there's a lot of data that we've already seen that quantifies just how much demand has grown, how much we're seeing both from a product growth perspective, but also the funds under management that are moving into this space. What this really does demonstrate is just how much demand is still coming down the pipeline and yet to be realized. So half of the respondents told us they're considering investing in ethical funds in the next 5 years, but more than half of those are actually considering it in the next 12 months. So the market is there to be captured for those who can do this really well. And I think that's a really important sort of finding to finish on. So that brings us to the end of the key findings. Now I'd like to and welcome back Barry Coates, as well as introducing our other panelists, Maria Loyes, who's the Chief Customer Officer at Australian Ethical Investments. Maria's been a close follower of this research over many years, contributed to these launches before. Kia ora, Maria. So, quick reminder, you can submit questions via the Q&A function. We've already had a couple come in already, which is brilliant. Please keep those coming in. We'll work those in as we go. Maria, I'm going to start with you, if that's okay. You know this research really well. You've done a lot of this research, both in New Zealand, but also in the Australian market. When looking through this report and the findings, what did you learn, or what really surprised you, and what came through in this year's report? Maria, I think you on mute. Now you go. Oh. Barry, I might maybe switch to you and kick that over to you. Again, you've been involved in this report a lot. What did you learn? What findings maybe surprised you?
Yeah, I think a couple of things, Dean. One is that strength of millennials and younger people really picking up this agenda. What we've seen in the past is that perhaps people think their KiwiSaver hasn't been big enough to really pay attention, but we're seeing now a really strong upswing, particularly in millennials, really raising their expectations and understanding of ethical investing. And I think in a period where there's a massive wealth transfer going on between baby boomers and young people, it's really important. And secondly, a widening of the gap between men and women. I mean, that's kind of a really interesting finding to us, that women are becoming keener and keener on ethical investing, and so those two demographic changes have been more pronounced than I guess we've seen in previous years.
Thanks, Barry. Couldn't have said it better. I'm back. So thanks, Barry. Couldn't have said it better myself. And I think that that changes. We're going to see that sustain with the Gen Z and Millennial. We're going to really see that continue and grow, and that the wealth transfer that's going to be going to those is going to be really fundamental in our market as well.
Wonderful, thank you, Maria, and glad that we can hear the sound coming through loud and clear. So it's wonderful. I think for me, the other thing that I'd really highlight, it's really interesting to start to quantify that difference between what it is that an organisation is doing and how it is that they are acting, and what kind of things they are doing in the marketplace around modern slavery, human rights. That's something that's really developed, whereby, if we did do this research a few years ago, as Barry mentioned, it really would have been about what don't I want in my fund, whereas we're now starting to see, rather than excluding particular industries, it really is the behaviours of those organisations. I think it's going to be really interesting to see, while environmental impacts were still really high, fossil fuels was quite a long way down that list, and yet those two are so inherently linked. So I think that's a really interesting development that, I'm kind of interested to see how that unfolds and changes the way we look at things within the industry. Another question, one of the other things that did jump out at me, I guess, the number of, or the percentage of people that believe that their funds are going to perform better in the long term continues to rise. We saw a sharp rise last year. It's gone up again this year. It really does speak to that, again, what was historically a conversation about returns versus values, whereas we really do seem to be transitioning to a values and returns being aligned. How does that shift, or what does that perception shift mean to the industry? And what kind of reflections does that require of us? Maria, I might start with you.
Yeah, look, I think, responsible investments, they don't look the same, and that's kind of the point, right? And I think, so we do see that there's some variability, particularly in short-term performance. I think that would be fair to say as well. If you've got underweight or overweight in any particular sectors, you'll see some variability, and probably, multi-assets, it tends to kind of smooth some of that out, but particularly in kind of, equities, you can see some variability short term. But I think what's really interesting is that, that plays out over the long term, and you can see really strong performance over the long term. And if you look at, our Aussie equities, for example, that's, performing, it's number one in the Aussie equities mainstream market in Australia. So I think that's kind of a real testament to the fact that actually you can really see this perform, and you would expect that sustainable companies are going to perform well in the long term. So I'm really pleased to see that the New Zealand market is starting to really understand that.
Thanks, Maria. Barry, did you have any thoughts on that?
Yeah, a couple of things. In one respect, it's not surprising because sustainability embedded in companies is good for their brands, and people love their brands, and their employees are motivated, and they don't get sued for environmental liabilities, and that doesn't always get reflected in market valuations. And so I guess on one level we shouldn't be surprised that there's this coherence between ethical practices and good financial returns. And it's great, we're a consumer-facing organization. It's lovely to be able to go to the public and say, hey, you can invest ethically, you can feel good about your investments, you can do good in the world, and you can earn good returns. And so it isn't that trade-off between returns and organic eggs, for example, where you pay a lot more for organic eggs than something that's raised in terrible conditions. But I guess the other thing is, it's not axiomatic, and it's not always the case. And what we found out through some of our recent research is that there are certain time periods where, of course, these things diverge, and there are short-term profits to be made. And we saw that particularly in fossil fuels over the last couple of years, that because Russia invaded Ukraine, it spiked up oil prices, and what we saw is a number of funds go rushing back not only into fossil fuels, but into the worst companies that are still increasing their exploration and production. And they're kind of trying to follow this sugar hit of investments. It's not good for the climate, and we think this is incredibly financially risky for the companies, given the risks of a downturn in stranded assets. And we've seen the same sort of sugar hit around weapons in recent times. And particularly we did research on weapons used in Gaza. And there are, of course, profiteering and high profits for some of those weapons companies. But the public really doesn't want their money going into those short-term profits for companies that are contributing to really terrible outcomes for civilians in Gaza. So we've had just a massive reaction from the public back on that issue. So it's where that diversion, that difference between short-term profiteering and long-term value, that we get some of the more difficult tensions to resolve.
Yeah, thanks. A lot to unpack in that, Barry. Maria, I might come to you as an investment manager, taking all of those things into account. And I guess, Barry, you raised a couple of really good ones there. One being, the environment and, fossil fuels on the back of what happened in Russia and Ukraine, as well as, variable temperature changes that are, still coming down, and, Europe is still going to have cold winters, and there will always be, you talk about those sort of short-term surges. Maria, as an asset manager, is it about being able to look at what are the other opportunities and what other things are going on in the environment to allow us to still be able to take advantage of great returns? There are obviously a whole lot of other industries that have surged during that time that don't rely on fossil fuels or aren't engaged in weapons. And particularly within the tech space, in recent times, for example, how do you as an asset manager look at sourcing those opportunities, and in your mind, does that come at the expense of that sugar hit that Barry was talking about?
Yeah, great question. I think I think we tend to be actually kind of ahead of the curve on public opinion in a lot of cases. And if you look at the Ukraine-Russia issue, we were never invested in Russia, and we never would be because of the regime, which doesn't meet our charter. And so if I think in this report, we saw that, customers were really concerned about investment practices rather than just kind of screening out particular sectors. And so, and that's how we think about it. So of course, we screen out some sectors that don't meet our charter. So we don't invest in kind of fossil fuel mining or tobacco or gambling, etc. But actually what we're really doing is looking at the whole of a business, because we're all about trying to support people, planet and animals. And so that means that we'll look at what are the human rights issues in a particular company. So, for example, we have not invested in renewable energy companies that are present in markets where we're concerned about human rights issues in the market, or that there are human rights issues in the particular company. So that's about looking at a very holistic view. And so I think then it enables us to really be ahead of that curve and see the opportunities for true kind of sustainable business practices. We can see that we're heading for a massive energy transition, and whichever way that goes, renewable energy is going to be a huge part of that. And that's an area that we've seen for a long time because of the kind of particular points, because of our charter and because of how we think the future needs to go. And so we're really experts in that field. We invest in a lot of New Zealand renewable energy companies, and it means that we'll continue to, I think, spot the trends and spot the opportunities in that space. So that means that, that there are times where that sugar hit, we might not be involved, and that's the kind of the short-term variability that I mentioned. But in the long term, when it's very clear that renewable energy and an energy transition is the way forward, we think that we're going to be really well placed.
Yeah, that's a great point, Maria. And one of the things I'd probably highlight from Maria's perspective and what we see is, I think the challenges everybody's seeing is that these things are becoming more and more complex as we go through, and particularly some of the geopolitical challenges. You cannot be sitting back and waiting for things to happen and be reactive to them. And so, one of the things we saw a lot of engagement with from members at REA, we've recently published a human rights and conflict toolkit for people to start getting on the front foot, because I think, more and more we're seeing as these conflicts develop, like there are markers that are out there. There are, policies and processes that you can put in place to reduce the risk in advance, and I don't think, I'm hopeful that we're moving towards a space where the days of waiting for Russia to walk into Ukraine are gone, and that, not just Australian Ethical, but, a lot of other sort of fund managers are able to identify some of those issues well in advance and make sure that whatever risk they are exposed to is, one, minimal, and two, any exposure they have to the region is done for all of the right reasons. Because I think that's the other thing to call out in some of those areas, is that there are, one of the challenges that comes about with some of that geopolitical conflict is that there are people who are doing phenomenal work in those areas. And I think it also requires us to think about, what are we trying to achieve through the ethical and responsible investment processes that we're putting in place, because we don't want to do things that are going to make it harder for people to get aid to areas and to provide support on the ground and things like that. So a massively complex issue, but one that I think we're investors are increasingly doing a better job of, but I think it will need to continue because I don't get the sense that things are going to get less complicated in the short term. Anyway, moving on to financial advisors, I think one of the big things we saw, more than half of Kiwis have sought financial advice at some point in their life. Again, there's a younger generation who are coming through who are massively passionate about aligning their values to their investments. Can you maybe talk, Maria, I might start with you. How does Australian Ethical work with financial advisors, and how do you see financial advisors as being really critical in this space?
Yeah, so I think there's obviously there's growing interest in responsible investing in the market, and we're also seeing the younger audience particularly having a massive increase. I mean, we saw an increase this year, but after a sharp increase last year in interest in responsible investing. And so, I talked about, we're going to have this intergenerational wealth transfer, and that's such a massive opportunity for advisors. And so, understanding responsible investing and being really involved in it we think is a really great opportunity for advisors. We are seeing probably some advisors are a little bit reluctant to engage clients on the topic, maybe because of client sensitivities or perhaps some of the greenwashing concerns are starting to raise their head in this market as well. So I think for us it's really kind of a two-part education process with advisors. It's kind of helping advisors to understand and really grapple with the nuances of responsible investing in a kind of client-friendly way. And we often share kind of client-friendly content and material with advisors that they can kind of pass on to their customers. But I think the second part of that, it's educating advisors in the opportunity. So how might their customers be stickier? How might they take advantage of this intergenerational wealth transfer that we're seeing? So I think it's a growing market. I think it's going to allow advisors to be able to refer more business, improve reputation, and I think the conversation is moving away from just pure performance to how can people align their investments with their values. We think that actually in terms of best interest duty, this is likely to become a requirement for advisors over time, and so we're keen to work with regulatory bodies on that and make sure that the questions that are being asked in the fact find process are kind of reflective of that. And so I know RIA have a course for financial advisors. We also have a masterclass with enrollments opening soon. So there's lots of resources and education out there for advisors to find out more.
Yeah, and that I think that potential requirement probably speaks to one of the challenges that sits within the financial advice space, which is that that is an area that has seen a huge amount of additional requirement piled on top of it in recent times. You mentioned, Maria, the Sustainable Investment Advice course that RIA's just recently launched. That was just in response to the volume of financial advisors and private wealth firms who were reaching out to us saying, we need to upskill our staff in this. How can you support us, and how can we start to build the capability across the industry? Barry, I might come to you with that in mind. How do you see the financial advice space playing a key role in this? And you're obviously doing a lot of great work in the industry with mindful money. How do advisors sort of currently engage with you on some of this stuff?
Yeah, thanks, Dean. And as the survey says, this is really increasingly an expectation of the public that when they seek financial advice, they'll be able to get expertise in ethical investing. A lot of advisors, of course, use our website because their clients do. And so people walking into a discussion with a financial advisor are often able to know what's within portfolios, certainly those based in New Zealand. We also do work for advisors and asset owners on unpacking AUTs and global investment funds to try and give a broader picture than just New Zealand funds in terms of portfolio analysis. So that's part of reaching out to encourage more advisors to get involved in New Zealand. Our perception is that there's a relatively small core of advisors who identify as ethical and do a great job of it. But actually, there's a lot who are outside of that realm who don't necessarily identify themselves as ethical, but are increasingly kind of interested in finding out a little bit more about the space. So we're keen to provide the research, provide the capability building, provide the updates that will help those advisors feel more comfortable about their ethical investment advice as part of knowing your client, is knowing about their preferences and values. So it's great that Rhea's setting up this program, and providers like Australian Ethical and others also providing assistance with that. It's something that seems to us to have been quite a long time coming. We do annual awards, which include an award for advisors, and certainly we'd love some new people to be putting up their hands to enter that category of financial advice, including the wealth managers who are often the largest sector in terms of financial advice.
Yeah, thank you, Barry. Might now switch to some of the generational differences, and we're getting some great questions coming through in the chat, so very much appreciate that. One question I've got raised, particularly around, you highlighted in the beginning, Barry, we're really starting to see women pull away from men in terms of the gender differences in terms of their values and their beliefs and how important it is to them. Is that a surprise? Happy for either of you to, Maria, probably start with you. Why do you think that is? Is it reflective of what you see at Australian Ethical?
Yeah, it is actually, and in the Australian markets, I think we've always seen a trend towards women being more inclined to be thinking about values and investments, I think that's just reflected here, and it's certainly reflected in our base to some degree. I mean, it's not black or white for sure, but we did tend to see a slight skew towards female investors. I don't think I'm in a position to say why, but I don't think it's a surprise.
No, fair enough. Barry, did you have any thoughts you want to unpack on that?
Yeah, I think that often perhaps women are a little bit more attuned to the effects of their decisions. They're used to, for example, in being consumers, looking for ethical options as consumers, and I think this conscious consumer attitude is extending into investments. So if you're looking at kind of ethical clothes or ethical shopping or ethical purchases across a whole lot of things, then why shouldn't you be looking at ethical investment with the same kind of motivation? And I think we're finding increasingly that women are realizing that, and perhaps they're a bit more attuned to that than men who maybe pride themselves on being data-driven and more around the quantitative financial returns, rather than understanding that investment has consequences, and those consequences have real-world impacts on people in the environment.
Yeah,
I think we've seen that for a long time, actually, and I thank you, Barry, for your insight around kind of the female and male perspective. So I'm really not surprised by this. I think our challenge is to help some of the more quantitative thinkers, regardless of gender, to be understanding that actually there is systemic risk involved in this, and actually that there is quantitatively some very grave concerns, and that actually this makes sense, and it makes sense certainly over the long term.
I could also add, Maria, one of the things just to watch and be aware of is that this is the kind of thing that, as the balance of KiwiSaver starts to grow, and the average KiwiSaver balance, which right now is comparatively low, if we do look across the Tasman to the Australian market, what we've seen is the gender wage gap has where it has really clearly become apparent is in the balance of super funds because of work gaps. But the increased likelihood of taking work gaps for maternity leave, things like that, again during prime earning years, but also the reduced pay that females are getting. All of that translates and is amplified by the balance of your KiwiSaver fund. And I think as the total balance of KiwiSaver funds start to grow across New Zealand, I think it's a really important thing for us to be conscious of, because we need, females are delivering a really strong voice and clearly stating some really strong intentions in this survey. We also need to make sure we've got the settings in place to ensure they've got the KiwiSaver funds sitting in their accounts to actually be able to deliver on some of this action, which is also a really important piece. I don't think it could be a conversation about investment in New Zealand without talking about climate-related disclosures. We have had a couple of questions come through about that already, and spoke already to information and the critical ability to be able to deliver information concisely to people. It was one of the barriers they cited, main barriers to not switching to an ethical fund. Now that we've started through the process of climate-related disclosures, a lot of that reporting is now being done, but obviously that is just stage one. What is that going to mean for the industry, and how does it translate into sort of deliverable change? Barry, have you got thoughts on that?
I think it's a great thing that climate disclosure is happening. The initial findings from what we've looked into is that it's going to be some time before people will be able to compare the embedded emissions of financed emissions across a whole portfolio between different fund managers. And I think that's partly methodology, so that there isn't yet a consistent methodology being used in New Zealand amongst fund managers to measure their financed emissions. Is partly the reporting basis doesn't go into enough depth to allow that comparability. The scenarios tend to be different between different reporters, etc. So unfortunately, that comparative basis, which is really potentially important, isn't going to be available for a while. But interestingly, some of the feedback on the early disclosures is that the value of them is seen to be in terms of internal discussions, internal strategies, what companies and funds are doing in order to manage their climate impacts. And I think that's where this gets interesting. It's primarily about climate risk rather than climate impacts. But actually, it kicks off a conversation that happens when you have to report this stuff around, so what are we doing on this? What are we doing about the transition? And we each year do a climate survey together with Investor Group on Climate Change and the Centre for Sustainable Finance. And we've seen New Zealand fund managers lagging behind their Australian counterparts and way behind the EU. So we're looking forward now to the focus shifting from climate disclosures into actually much more of the taking action on the transition pathway and the driving down of emissions in portfolios.
Maria, you're in a different jurisdiction, but again, climate-related disclosures coming down the pipeline and some comparability to what's going on in New Zealand. How do you see, I guess, irrespective of it just being climate-related disclosures, there's no question that what we're seeing is a move towards more disclosure, more information, and a broadening of what that is, of what's going to be required. How do you see that changing the way we're delivering information to customers?
Look, I think there's two parts to that. I think very, very much welcome the climate-related disclosures. I think it'll make that, I think it'll make life a lot easier. I think there is a period of transition. I think the other side of the kind of regulation change that we're seeing is some consistency in frameworks around how we label investment products and how we talk about investment products and provide comparative information for consumers to be able to understand what is the difference between different funds and what is how might they be allowing them to invest align their investments with their values. So we really welcome that as well. I think it can be confusing for investors at the moment. We try and provide as much information and help people to understand what it is and how we go about it. But I think it's probably hard sometimes for consumers to compare different fund managers. And I think ESG particularly has been really problematic. ESG has been kind of used as a broad term for sort of responsible investing, but also it's actually a investment practice in itself. And ESG integration means that you look at factors of environmental, social, and governance, and you value that in the portfolio. So, do you think that there's an environmental factor that's going to cause that stock to be at a lower value, and then if you think the price is right, you might invest in it anyway. And that for us is not a kind of the type of responsible investing that our customers are looking for. And it's concerning that perhaps some customers are going into an ESG investment thinking that actually they are aligning their values with their investments when they're actually not. So I'm concerned about some of the impact then on consumers and their perception of the investment industry.
Thank you, Maria. Final question, and just conscious of time. I think one of the things we've seen is, and we've spoken about, I guess, customer expectations are shifting and evolving. I think one of the other things that we're really seeing in a New Zealand context, we've seen borders open up. We've seen a huge number of migrants arriving into New Zealand, and a real shifting landscape of the makeup of the Kiwi demographic. Barry, can you maybe speak to what that means when it comes to providing maybe more specialist type of investment options? There's a couple of questions, have been raised from the audience, and thank you for those around, specifically around, the generation and Gen Z needs. There's one about, the increase in Muslim people living in New Zealand and the ability for us to be able to deliver compliant funds that are meeting their beliefs and understandings. One of the huge ones that we always see is animal welfare, measuring high up, on the areas of concern for Kiwis. How does the market, well, I suppose the question here is, are we serving those smaller groups well at the moment, and what kind of might need to change? If not, what might need to change?
Yeah, I think the news on this, as you know, Dean, is pretty good insofar as in the early days, there's one flavor of KiwiSaver and the color is black. It's kind of like it was like a standard set of funds that were very much kind of almost all listed equities. They were, followed a certain formula. But in recent years, there's been a far greater diversity of funds now available. So if you want ethical funds, you can find them on the New Zealand market. We'd love to see some more providers come into New Zealand. Yes, please, Australian Ethical and others, because it would be good to have a greater range, and this is happening. But there are now far more specialist funds. There's funds that invest via Sharia law for targeted at people who have Islamic faith or a broader audience as well. There's funds that exclude a lot of stuff and are passive investors at low fees. There's funds that have a very active strategy and a core of very highly ethical companies. So now with 376 KiwiSaver funds and about 500 retail investment funds, people can start to find their funds identified, and certainly I know from Ria's work, but also Mindful Money's work, we try to make that available to people and say, here's the range of funds. What are you really interested in? What are your values? What are you looking for? And present the information so that it's easier for people now to work through those issues and find the particular funds that meet their values and meet their investment needs.
Yeah, thank you, Barry. So look, coming into closing comments now, would be keen to know, Barry, you've done this a long time, and Maria, I'll come to you next. You've done this for a long time. We've been looking at this research for a long period of time. what's the call to action having read through this report today? If you're on the call, whether you're an advisor, whether you're an investor, whether you're a fund manager, what's the call to action having read through this report that you want people to take away?
I think, as you referred to on financial advice, and Maria referred to, I think there's a particular call to action for financial advisors out of this research, and I think that came through quite strongly. I think that the takeaway for fund providers for the general market is be aware that the demographics are changing, and the younger investors are your future as customers, and they want a deeper level of ethical investing. And the kind of, as Maria referred to, the kind of ESG light, let's deal with a little bit of risk in a few funds, isn't really enough anymore. That actually there's a higher expectation, particularly amongst women, particularly amongst university educated people, particularly amongst younger generations. And I guess the third one for I guess again, this is fund managers, as to pay attention to what's happening in the world. I mean, as we saw with the Russia's invasion of Ukraine, those who didn't use ESG and other practices proactively lost a huge amount of money through their investments in companies that were aligned to the Putin regime. Lost 100%, 90% of their investments. So these kind of geopolitical risks, these kinds of ethical risks are real, and they have financial consequences. And think for the long term. Don't follow these short-term sugar hits.
Maria, over to you.
I think for me, this is probably two areas. First of all, I think we saw in this report that impact, so not just screening things out, but actually creating positive real world impact is what people are looking for. And I think that that's the beginning of a much broader trend. And I think, as a fund manager, we've been investing in impact funds and also kind of, infrastructure debt. So that's, I think, going to be a trend that continues. And then I think, there's a broader call to action that, look, this isn't philanthropy. This is, it makes money, it makes sense. And I think for the whole market, we need to make a big change, and it's money that makes the world go round. So, get on board.
Wonderful. Thank you so much, Maria. And thank you to both of us for joining, for your comments. Final call to action from me and from Maria. We have got our annual Aotearoa New Zealand conference, which will be coming up 19th of September. It's going to be happening in Auckland at the Aotearoa Centre. We've got a huge lineup of amazing speakers from right across the industry. It will be the largest event of its kind in New Zealand this year. So if you're not already registered for that, would highly encourage you to get involved. So in terms of wrapping us up for today, again, look, huge thank you, Barry and Maria. Huge thank you to Mindful Money and the team in there, as well as Australian Ethical Investments, who continue to support this amazing mahi that we're trying to. It's a challenging landscape, but there's so much opportunity, and it's terrific to be able to deliver some really tangible information to hopefully help people deliver on some of the opportunities that exist in the market. Quick reminder that a recording of this event is going to be emailed out to you this afternoon, along with links to the report. You can also access those on Ria and Mindful Money's website. Thank you so much to those of you who have joined us for the webinar today. Have a fantastic day in Matewa.